Welcome to Forecast. I'm Darren McDermott. Today I'm joined by Jacob Andreasen from ALM Markets to gain his forecast on the euro dollar. So Jacob, in 3 months' time, now you see the euro trading at 143 and then falling to 142.50. So what major economic events will you be closely watching that may impact this pair?
Well, the consensus euro-dollar forecast for the end of the second quarter is 133, and I guess this consensus forecast is partly driven by the rate differential that point toward a stronger dollar. But the problem using a standard 2-year govie spread is that it does not fully reflect the real spread. That should include the EUR and cross-currency effects. So if you use the implied rates from the FX market instead, the spread point towards 137 instead of 130. So a much less bearish factor than perceived by the majority. Second, it seems like the euro has turned into a safe haven currency lately. The rate outlook determined by the ECB forward guidance has turned euro into a funding currency. When carriage rates suffer in times of lower risk appetite, the euro appreciates. So the usual euro-dollar versus risk-off pattern that we've seen over the past years does not exist any longer. Third, the flow into government bonds of the European peripheral countries has so far been supportive for the euro and one of the reasons behind the current levels. And we believe that the spreads can tighten further in the coming months before we see a minor reversal later this year when the spreads has become too compressed. Actually, if you only look at these spreads between 10-year govies, Germany versus some of the peripheral countries, and we assume a move back to levels from 2009 in these spreads, it would take euro-dollar closer to 150.
And in the long term, Jacob, you see it depreciating further to 134. Now, is this target based on a more bullish outlook for the United States?
In the second half this year, U.S. macro will gain momentum, and before year-end, they have finished tapering in our view. So the short end will begin to move, and euro-dollar will fall accordingly. Having in mind the recent press conference from Draghi, there's also a limit to how high euro-dollar can go before the ECB members start to react, talking it down again. My calculations show that if we move to 143, it will put a downward pressure on the inflation rate of approximately 0.2 percentage points. And further, the appetite for European bonds will disappear if the spread compresses materially from the current level, providing less support for the euro in the third and fourth quarter this year.
Jacob, thank you very much. Well, Natalie MacDonald will be bringing you the next forecast on Friday. Goodbye for now.